There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice, brought to you by TackleTrading.com.
Welcome back to the Trading Justice Podcast presented by Tackle Trading, where we are teaching people how to get in the game one trade at a time, changing their life one trade at a time. If you have a retirement account, if you have IRAs, 401ks, if you are just a casual investor in the stock market, if you're interested in making a lot of money, go over there to Tackle Trading and check out everything we're doing from, Gino Poor's options report to my Forex report to Tim's commodities report, and coming soon, Noah Davidson, who is our amazing guest here today, his stock report. Noah, how are you today? Oh man, I can't complain. Just sitting here on a nice little Tuesday morning, enjoying the sunny weather of Salt Lake City, Utah.
Gotta agree with that for sure.
No doubt. Hey, Noah, I just made a post over there at Tackle Trading, and I want to run by some data for you, and I want to get your take on it. I call it the Recession Data Watch, and basically the reason I called it the Recession Data Watch is twofold. Number one, seeing what our economic data is. It's been fairly negative the last few months, but also the Fed is very data driven right now, given the fact that they're really focusing on economic data in terms of their interest rate hikes. So I'm going to read just a couple the last couple months for you from March, April, and May. Some of the major economic reports. Okay, so in March, ISM manufacturing came in at 52.9, which was a miss based on the expectation. Retail sales came in at negative 0.6, another miss. PPI report came in at negative 0.5, yet another miss. Consumer sentiment, 91.2, a miss. Housing starts, 0.9 million, which was another miss. Existing home sales, another miss. Durable goods, negative 1.4, another miss. Final fourth quarter GDP of 2014, 2.2%, which was another miss. And ISM manufacturing data, which was another miss. Now, that was in March, Noah, and literally every major economic report we had in March was some degree of either a miss based on the expectation or a very, very big mix. Now in April, unemployment came in at 5.5%, which only created 126,000 new jobs. Another big miss. ISM manufacturing, 56.5, another miss. Retail sales came in at a positive 0.4, which was a miss. PPI report, 0.2, another miss. Building permits, 1.4 million, which 1.04 million, which was another miss. CPI came in at 0.2, which was expected. The University of Michigan Consumer Sentiment Report, 95.9, which was a slight gain. Durable goods, negative 0.2, a miss. Consumer confidence, 95.2, a big miss. Advanced first quarter GDP analysis, 0.2, another big miss. And the ISM manufacturing came in at 51.5. Now, that was another miss. Now, that is April, which, only one economic report came in, which was an increase over the expected, and that was the University of Consumer Michigan Sentiment Report. Now, Noah, you've been doing this for 15 years, going on, even longer than that. Why is it that economic reports are so important to the active individual investor, trader, and the market as a whole?
Well, it's data driven. It's just one of those things where they're always looking for that information inside edge, anticipating the market's next move. And, just based off your report right there, that's giving you some leading indications of what is going on. It really explains why we see price action on the major indices slowing down. Reminds me of the magic 8 balls, pretty much. That you flip it over, it says all signs point to yes. Are we going into recession? All signs point to yes. It is certain. That's a lot of data, and I'm a technical analyst, and if you really think about what we are analyzing, we're analyzing the behavioral patterns in the market. An economic analyst and a fundamental analyst, they're going to be focusing on the numbers. And that's going to be the decision points for the longer term buy and hold crowd. They're going to be paying a lot of attention to the data.
From a technical analysis point of view, and you're the author of Master Trader. I mean, you wrote the book on technical analysis. You can pull up a chart, and without even comprehending, data, without even thinking about it, you know exactly the probability of it going up, down, or sideways. From a technical analysis point of view, why does this data not matter from your point of view?
Why does it not matter? As in, why has the market not reacted sooner?
Yes.
Because I think they're smoking hopium. A little bit of optimism out there. There's a fear of recession. It's one of those things like almost wanting to admit that it is so. Hoping that the next bit of information is a little bit stronger. Not wanting to jump the gun off of one small economic report, but if we keep hitting it month after month, eventually it'll give way to I guess probably to calmer heads. It's the market. Some of the bigger parts of the market, the longer term money doesn't move that quickly, whereas a lot of the the daily movement day to day is really just driven by pure technicals. It's driven by the trading robots. It's been driven by the higher frequency traders. But the longer term patterns, we just don't see really quick knee jerk reactions as to the data is really, and it's not that it doesn't matter. It's just that it takes time for it to really sink in.
Well, and also there's just so many of them. There's so much data out there that the active trader isn't going to overreact to one piece of data or 1 month in the market. When you're talking about for example, in May, March and April were two of the worst economic months we've had in quite some time. The first quarter of this year was one of the worst quarters we've seen in quite some time from a GDP perspective, from a national economic perspective. But you never want to overreact to just 1 or 2 months, because looking at in May, I just updated it for the May. This is we're sitting here on June 9th right now, but just updated for May. Unemployment came in at 5.4%, which was no change. ISM non-manufacturing data, which had been negative for the prior 2 months, came in at a very healthy 57.8, which was better than expected. You had building permits that came in at a slight increase. CPI report came in at a slight increase. Consumer confidence came in at a slight increase, as well as preliminary GDP. Even though it was a negative 0.7, it was still an increase over the expectation. And then the ISM manufacturing PMI report came in at a slight increase as well. The biggest things that I'm seeing right now that I'm a little bit concerned about coming into the May and now coming into June is really the consumer behaviors out there, Noah. I mean, for March and April, consumer confidence numbers were big time misses. Retail sales numbers were probably the biggest negative to the marketplace over the course of March and April. And even in coming into May, retail sales came in at a big miss. We're now going to see some retail sales numbers for June that comes out later on this week. Talk to me about why it's important from an economic perspective, or from a national economy, consumer spending behaviors.
Well, my favorite technical setup in the marketplace right now is the entire retail sector. The entire thing. All of the bigger retail stores have really nice bearish reversal technical patterns. You look at some of the big box retailers like Target, you already have Walmart in a significant downtrend, but you have some of the bigger players like Target and Costco all poised for nice big breakdowns, and that has a lot to do with that data and information coming out. At the end of the day, the bottom line stops with the consumer and consumer confidence. In an economy that is consumer driven, that confidence is such a psychological underpinning where if they're out spending, or if they're starting, if they're working on saving, and it's just a general cycle that we go through, and after consumption, oftentimes you'll see consumers get to the point where they now they have to pay down their consumer debt, et cetera, et cetera. I think that there's so much data information. One of the things you alluded to is there's so much of it. We have a wealth of information, but a poverty of attention. We don't really have the ability to watch all of those things. So me personally, I just watch for the major reports. And more importantly, I don't really watch the report so much as I watch the market's reaction to the report.
Yes.
The report.
And that's probably the most important thing. I do want to say something, what you said about the big retailers here. Just in the last couple months, Target, you mentioned Target's off its highs, the highs of 85. It's currently down at 78.35. Walmart, one of the biggest retailers out there, at its highs a few months ago, coming in at about 90. It's already down to 72. No, I mean, an 18-point clip on a $90 stock. That's about over a 20% drop already in Walmart, based on a lot of those retail sales numbers. And Costco, coming off its highs of 155, is already down to 138. So despite the marketplace still kind of going neutral right now, in the last couple months, you're really neutral. And for the year, the S&P 500 is in the slight red, not terribly, but a lot of these retail stores are already getting beat up pretty hard. So, from those breakdown perspectives, these numbers, if you're seeing certain segments of the economy that are really, really struggling, like retail, and retail's been the biggest laggard of the market from an economics perspective. You go out there and look at some of these stocks out there that are, consumer driven, and all of a sudden they're showing signs of bearish market already. And so that represents an opportunity to a certain extent. When you see one area of the national economy really struggling, it's probably going to be a direct correlation to those individual stocks in that segment as well. So good call on that.
Well, yeah, I mean, absolutely. And it is just one of those things where I don't really necessarily need to be able to predict the market, don't need to be able to interpret or even understand half the economic data. All I really need is to be aware that they are the insular or the major underpinnings of the market, and that the reaction, the chart, is really what matters most of all. Because it just comes down to how traders and how the market overall reacts to the data and information. Because sometimes it seems like, the market doesn't react to the data. Like, you might think to yourself, oh, that's definitely a bad economic report. And then the market stays strong and rallies through for whatever reason it's doing so. So, you have to just be, one, aware, two, paying attention, and three, taking action. Because it's the inaction that gets you. It's not it's the not doing anything, sitting back and letting trades turn bad, or investments turn bad if you're not staying on top of it.
It's you look at the economic data right now, and you're really kind of on Fed watch to a certain extent. When you were coming into March and April, and this is kind of how I project interest rate, when the interest rates are going to hike, because the Fed is watching this data, and interest rates have so much to do with the direction of the market, much more than the actual economic reports do. So when you're looking at the data here from March and April, prior to March and April, there was a lot of anticipation that the Fed was going to raise rates in June, and the Fed is meeting next week on Wednesday regarding monetary policy. But after March and April happened, you started saying, okay, the Fed's not going to raise rates in such a nasty economic environment. And then you started seeing data saying, well, they can't even raise them this year at all, with how bad the first quarter of this year was, how bad the global economy is right now. And while everybody is, everybody meaning the other 7-8 major central banks out there, like, the ECB and the Bank of Japan and the Bank of England and the RBA, the Royal Bank of Australia and whatnot, how they're all lowering interest rates and doing quantitative easing, the Fed is looking to raise rates in that environment. And so you see these negative economic reports and back-to-back months, and you see all this projection saying, well, now we're looking at 2016 for interest rate liftoff. And then we get this month, and this is kind of the frustrating thing with the Fed right now. And then you get this month in May, and you're like, well, unemployment data wasn't that bad. Manufacturing data wasn't that bad. And so the economy kind of rebounded just slightly, not a lot, but just slightly in May. And then all of a sudden you start hearing, well, it's certainly not going to be June because of March and April, but because of May, you might see an interest rate hike in September. No, I want you to talk about why interest rates are so important to the Fed in raising interest rates in terms of the market direction. What is your anticipation when the Fed raises interest rates? How is the market going to respond to that? It's such kind of a complex concept to kind of wrap your brain around.
Monetary policy in general is probably the single largest factor, in my opinion, right now, really driving the economy. It's really what the stimulus packages are really based off of, quantitative easing, and so you have massive amounts of debt out there, and U.S. dollar debt, and then you've got the need to continue to stimulate the economy. Raising interest rates is kind of a double-edged sword. It can serve to strengthen the U.S. dollar, but it could also serve to scare people that the rising interest rates will slow down economic stimulus and people will stop borrowing because the cost of money is rising, and therefore they'll stop spending, and so it'll trickle out. But they can't leave those rates down there low forever, because they need to have, historically, when it comes to markets correcting and the quote unquote invisible hand, if you will, being able to prop the market up and stimulate the market. If you go back and look at the two last major market corrections in 2001 and again in 2007 and 8, the Fed's toolbox primarily consists of that monetary policy and the ability to lower interest rates to stimulate the economy, to prop the market up, has been their number one toolbox. And so this time, if they have interest rates at the all-time lows and they, the market goes into correction mode and we see people get nervous and panic and we see a steep sell-off in the market, they don't have any more bullets left in the gun. They can't drop interest rates any lower. They can go negative on the interest rates, which we have seen. But my anticipation, I think, is that they want to raise those rates slowly and surely. They don't want to pull the trigger too soon, and I anticipate that they'll be doing it, I'm guessing, third or fourth quarter this year, kind of contingent on what I think their data-driven decision. Because like you said, they're watching that data, and we're really in uncharted territory. So trying to predict what the Fed's going to do, is challenging. But from everything I've been studying and reading, I'd expect October-ish.
Yeah, it's very difficult to understand the Fed. Number one, they don't talk like normal human beings. They talk in Fed speak. They talk in data, and quite frankly, they're economic philosophers is who they are. And so when you talk about the Fed, it's very difficult to interpret kind of when they're going to do things. For a couple of years, I was anticipating summer of 2015 that you would start to increase interest rates, and a lot of that was just due to they were doing quantitative easing. They were in the thralls of printing $85 billion a month into the market. And then when you start understanding kind of, their monetary policy statement, where they have these different phrases in the market where, whether it's a considerable time language or a patience language, whenever they have that, they're not going to raise rates anytime soon in that capacity. And when you're just looking at the overall market cycle, you're really talking 2015 when you're at the top end of that market cycle, when you're looking at historical market cycles. And you're absolutely right. The Fed historically has combated the recessions that we've had since, 1929, 1933, 1936 through interest rate policy, in terms of raising interest rates at the top of the market or lowering interest rates at the bottom of the market. So for a very long time, I was anticipating a June interest rate hike, but now we're getting into June, and the Fed speeches aren't really suggesting June. The monetary policy statement we got last time wasn't really suggesting June, and the data wasn't really suggesting June. Now, I would not be utterly shocked to see June. It wouldn't just blow my mind away. I still put there at about a 10% probability, very unlikely, but about a 10% probability of a June hike. But now you're looking out at September, October areas, and that's when I probably expect liftoff here, because Noah, you're absolutely right. If this market starts going down and the Fed doesn't have any bullets to throw at the bear market, watch out below. I mean, we're talking about the economy that is not as good today as it was in 2007, when they had ammunition to combat bear markets. The interest rate was at 1.75 prior to the bear market of 2008, 2009. You're currently at a recession, at a economic level that is very similar to the one that was prior to the subprime, but interest rates are at zero right now. And you've also had, $4.5 trillion of quantitative easing programs in that exact same time frame. And so I look at this, and if the bear market does start to hit us, and we're certainly not there yet, you're still I would say you're in a neutral market right now. But if the bear market does hit us, and you don't have any ammunition to throw at that, how is the Fed going to stop that? I mean, I was thinking the other day, Noah, that if they didn't have interest rates, and the only thing they have in their arsenal is another quantitative easing where they print money, you're not talking about another $1 trillion quantitative easing package, because that's a drop in the bucket to a market that is at an all-time high. You're talking $2 to $3 to $4 trillion of more money that has to be put into the market to continue pumping the market, and not only that, but reinvesting into the market itself the interest accrued of the bonds that they currently own, which is about 38% of all U.S. debt. That is a very, very scary situation to be in. And my hope is, and I mean this, my hope is that the Fed does raise rates. Because if the Fed raises rates, I certainly see a bear market happening. But the longer you manipulate this market, the worse the outcome is going to be.
Oh yeah, and I think that they're just walking this kind of tightrope, if you will, of raising it too soon, kind of spooking the market, versus raising it in a fashion that could actually build confidence. I mean, if they actually do it in the right fashion, they can spin this so that raising rates shows that the economy can handle a rate hike, and that will be a sign of strength, and it can actually help keep things going. But it can all come down to timing and spin on that, because otherwise it's they are going to be raising the interest rates, and that's going to make money just a little bit more expensive, and that'll decrease the overall flow of money. And ultimately it gets passed on to the consumer as that federal funds rate goes up. So does the bank rate. So.
Well, and no, I also think, and this, I don't think many people are talking about this outside of us that tackle trading, but when you start increasing interest rates, it's going to be much more difficult for companies, S&P 500 companies, Dow Jones companies, NASDAQ companies. It's going to be much more difficult for companies to borrow money to do their stock buyback programs. And that's one of the most unreported things that has happened over the course of the last really 2-3 years. Is what's really kind of driving this market isn't just pure supply and demand. It's to a certain extent bribery with the stock buyback programs. I mean, you're talking just last year over $650 billion in stock buyback programs. You're talking already close to $300 billion in stock buyback programs this year, and a lot of that is done through borrowing and buying bonds, and even Apple issuing their own bonds based on where the interest rates are right now. So it's going to be interesting to see how the market, from a company perspective, impacts the stock buyback programs that we've seen. Also, last year alone, we saw a record number in mergers and acquisitions. $2 trillion worldwide of mergers and acquisitions, which is much easier to do when you have historically low interest rates. So how is that going to impact mergers and acquisitions in terms of an interest rate hike when you're talking about the largest market and with the largest dollar and the largest bond market here in the United States? So it's certainly going to be an interesting thing to review and to see play out over the course of the next few months with the Fed, and I'm really anticipating that Fed meeting next week. I'm not so much that I think they're going to do anything, because they don't, but I want to read their monetary policy statement. Are they going to give the market a hint to when they're going to start liftoff? And typically the Fed doesn't tell us specifically what they're going to do. You have to interpret the Fed speak. But I am anticipating that next week, and we'll certainly have more podcasts, and I'm sure we'll do more videos, and we'll talk about it on the Coaches Show and everything else we do over there at Tackle next week. So we'll look at that. But I want to change topics for right now very quickly. No, and I want to talk about the mindset. I want to talk about investor traders mindset and consumer mindset. Noah, you've been a part of Rich Dad Education for many years, since 2002. I've been a part of the organization since 2005. You were the author of Master Trader in 2009. And you and I have been the primary speakers and educators for Rich Dad and Legacy Education, where we go out there, 2-3 times a month and introduce trading systems and introduce investing and introduce trading strategies to people who are very new to the market. And what I want to talk about, Noah, is I want to talk about the difference between the investor mindset, the business owner mindset versus that of the consumer mindset. What are the 2 or 3 things that you think, based on all of your wealth of experience, stops consumers from meeting their ultimate success?
The fact that they have a consumer mindset. That is exactly the primary problem, because they bought the bill of goods that they're sold. People are conditioned, and it's by design. In every aspect, the American dream, really, if you look at it, is a home and 2 cars in every garage. Go to school, get a good job. We are not.
Don't forget the 1.38 kids.
Yeah, my first kid was great. That 0.38 kid, that kid is a nightmare. Yeah. But that's the entire way we have allowed ourselves to be conditioned as consumers, where our entertainment constantly feeds us these messages, and people are, for the most part, are kind of running around in a hypnotic trance, thinking that they're making choices, but all they're really doing is reacting to those advertisements. If you really look at what people are sold when it comes to investing their money, the number one message is that the stock market, the financial markets, is hard. It's complicated. It's not for you. You need to give your money to a trusted advisor, somebody who's smarter than you, that can take care of your money for you, because it's so hard and complicated.
No, I want to speak to that real quick, because it's so important. The Wall Street mindset is that the American consumer is dumb. The American consumer isn't intelligent enough, isn't educated enough, isn't good enough to manage their own money. And they've been selling this bill of goods for 40 years. And that is the biggest horse shit I've ever heard in my life. But the crazy thing for me is that the American consumer buys it. That's the crazy thing for me, is that they are told that they're too dumb to manage their own money, and the American just says, you're right. In any other capacity, if you told the American consumer, the American mindset, that they're too dumb, they're not good enough, they're not educated enough, they're not intelligent enough, they're not good looking enough, the American mindset is just to go prove them wrong. Except when it comes to money, and then they're like, oh yeah, we're not that good with it. You got to break the bonds of that slavery. It's ridiculous.
Well, it really is, and it's a constant, steady messaging, and the idea of going to school, getting a job, working through that career, saving for retirement. How many commercials do we see where we are conditioned to save for retirement, contribute? How's your financial advice?
Get on the green line.
Yeah.
All you have to do is get on the green line. Fidelity is amazing, because these advisors, these institutional traders, they don't actually do anything in managing the consumer retirement accounts. They plot you in a mutual fund, and then they never look at it. They never invest in it, and all they do is they do these marketing campaigns, which are genius, and they market with green lines. And when they send you the report, they color you green, because green has that triggers that mindset. Oh yeah, green's good, green's go, green's everything. It's like a stoplight, for crying out loud. And then they market with babies, and it's utterly ridiculous that the American consumer buys this. But I just keep going back to Larry Fink and what Larry Fink said last year. Larry Fink is the CEO of BlackRock investment firm, and literally one of the largest institutional firms in the world where they manage mutual funds and other people's money and whatnot. And Larry Fink basically said this is how pompous, arrogant, and flat out don't give a damn that the Wall Street institutional trader is about the American, because they know the American consumer right now is so complacent that they're not even paying attention. Larry Fink came out with an interview last year with CNBC, Noah, and he basically said this: the only reason we are in business, meaning BlackRock, is because the American consumer will never put forth the effort for their own longer-term gain. I mean, just think of how damning of a statement Larry Fink and the other cronies on Wall Street basically said about each and every one of us. It's disgusting and it's sad, but you know what, Noah? It's not a lie.
It's sad because it's true. And
exactly.
If you had a segment of the population that bought into that, but it's the entire population. And the messaging is, I mean, it really comes from the culture, our schools, the lack of financial education all the way around is by design. And if you don't think it's by design, you're not really paying attention. It's what the American, to quote Ray Zelinsky from the movie Tommy Boy, what the American public doesn't know is what makes them the American public.
Great quote. Good movie drop right there. I like it.
It's one of my favorite truths of all time. Nobody cares more about your money than you do, and that's actually behind the name Tackle Trading. When coming up with that brand name, it really is get after it, get out there, get in the game and do it yourself, because you can do a better job. It's not rocket science. It does require the right kind of training, information, and education, and really more than anything, coaching and mentoring. It's what really makes the difference. When you really look at wildly successful people, the pattern is that they have mentors, they have teachers. You don't have to reinvent the wheel, but you certainly don't need to give your hard-earned money to a mutual fund advisor or a financial planner, because it just, there's one of those commercials out there that reminded me of that when I was sitting down with my financial planner and we were talking about my kids, future. It dawned on me, were we talking about my kids' education or his kids' education? It really is just that. The financial planning industry is all about assets under management, and
it really is. It amazes me, because we sit here and we have a different perspective, because we've been in that fire for a very long time. But you and I we've taught thousands upon thousands upon thousands of people how to trade. We've seen more people than we can count, not only control their financial lives, but do better than Wall Street, outperform their mutual funds, put themselves in a better position for retirement. We've seen people like Steve Wong, who basically in 3.5-4 years paid off hundreds of thousands of dollars in debt through their trading, and now quit a $180,000 a year job just to focus on trading. We've seen people like Dean Beckett do the same thing. We've seen people like Jake Pelly do the same thing. We've seen countless stories of people who control their financial lives and really separate themselves from the economic growth of Wall Street to more of a personal level. But yet, when we go out there, and you were in LA this past week, I was in DC. Combined, there's 150 people in those rooms, and there's something when they're first starting out, they see it so daunting, so difficult, so hard. And I always tell them, I say, hey guys, listen, just because it's new doesn't mean it's hard. It's just new. You can't associate those two in the same. When I look at it, there's really three things that I see that stop people from when you're just flat out ignorant, you're just flat out ignorant. You're not even self-aware of the other possibilities. But I'm talking about people who are now aware of what they can do. They see what they can do. They see how easy it is to outperform Wall Street. They see how easy it is to outperform their advisors and outperform mutual funds and separate themselves from the middleman and add, percentages every single year to the bottom line simply through clicks of buttons. But there are three things that really kind of, stop the consumer from taking advantage of this. Number one is they think their problem is money. That's what they think their problem is. But then when you ask them, Noah, you say, hey, listen, if you took any successful person and you stripped them of all their money, all their credit, all their contacts, would they be successful in a year from now? And they always say yes. They always say yes, but then we're like, well, then how can money be your problem when you just said that if you stripped any successful person of all money and contacts, they would still be successful? And they're like, well, what's the difference in those two people, the person without knowledge and the person with knowledge? Knowledge is the tiebreaker. It's not money. Money's not your problem. In an area where you're dealing with trillions and trillions and trillions of dollars, you can't say money's your problem. It's your lack of knowledge. It's your lack of ability in terms of getting money that is your problem. The second thing I would say is people that stops people from gaining ultimate success is fear. Fear is just, it's grappling. But most of the time, Noah, fear is not real. Like, remember when we were a kid, we were scared of the sounds of the house? I remember growing up me and Tim, we were in the basement of a 2-story house when we were growing up, and just kids. And it was an older house, Noah. And there was literally these sounds every night. You would just stay up at night. You're 7, 8, 9, 10 years old, and you'd just be staying up at night just listening to these sounds, and it would just be scary, and your mind would play tricks on you. But it was just the house. It wasn't a ghost. It wasn't a monster. It wasn't nothing. It was not real. I mean, well, there was one night when I was 12 years old that I thought I saw something. I will say that. But outside of that one time, it wasn't real. I mean, no.
Brian got in a fight with a coat rack at the top of the stairs in the dark. So I get what you're talking about. Irrational. It's that acronym, false evidence appearing real. It's in your head. And I think one of the interesting things is if you go talk to people who are successful, they've had more failures than you can count. And those who are, whine and complain of not being successful, well, they don't have any failures because they haven't taken any risks. And what you learn when you fail is that you survive. And
how many failures have you had, in life in general? I mean, more than we can count, right? I mean, but that's why you're successful, Noah, is because you're getting out there and you're putting it out there, and you learn from those failures and you grow from those failures. And it's about the journey, and it's about embracing the journey. I don't know a successful person, not in business, not in life, not in relationships, not in money, not in trading, not in anything, that didn't have some failure along the way. But failure doesn't stop us, I always think back, and Noah, you and I have a mentor. His name is Jim Francis, and just a great guy. And he tells a story about one day when he was getting mentored by Tony Robbins. And he basically says, he was getting in front of this firewalk, and he was so scared. He was so scared of these hot coals and these burning coals, and he could feel the heat on his legs, and he was just so scared. And then all of a sudden, 1 second, he takes a step out onto these burning coals, and he finishes the firewalk, which is about 8 to 10, 12 feet long, just depending. He finishes the firewalk, and he comes back to Tony, and he says, Tony, why'd you push me? And Tony says, Jim, the one thing I knew, that if I could get you out onto those hot coals, if I could give you a little push, you'd be real motivated to finish. You'd be real motivated to take that second step. And I've always kind of seen that from a trading environment perspective, that, I don't know how many trades you have under your belt, but it's got to be tens of thousands, and same thing on my side. If we who have this experience and have seen that it's not that scary, if we can get them to just get out there and make that first trade, if we can get them to get out there and just buy a call option or buy a put option or sell a naked put on USO or do a covered call or whatever it is, whatever strategy, a credit spread or whatever it is, if we can get you to make that first trade, you're going to see that it's not that difficult. It's not that crazy. It's not that scary. And that you can make a lot of money along the ways. And if we can do that, you're going to be very motivated to make the next trade and the next trade and the next trade. And that's what mentors do for you. That's what coaches do for you. And that's what we at Tackle Trading, that's what we do for our clientele. through our scouting reports, through our market reports, through our market recaps, through our coaches shows, through our everything we do over there. We're just getting people to take control of their lives, take control of their financial future.
Oh yeah, and I mean, it really is.
Time.
I mean, I think the hardest trades for people are the first trade they take, and then after they have an expense trade, they learn a lesson or two, taking the next trade after falling off the horse, if you will. But once you learn that your risk is directly correlated to your control. And the funny thing about the markets is they are perceived as so risky. But the truth of the matter is there is no other place in the world where you can control the risk as much as you can in the financial markets. Because who is the person who makes those decisions? You are. Who is how many instruments do you have? Who gets to choose the position size? Who gets to who gets to choose your entry, your exit, your stop loss, your hedging technique? You can't mitigate all risk, but I can tell you the market correcting down right now, Matt. I had a handful of trades that went south, but because I knew how to make adjustments, I've been able to take those trades and change them and alter the outcome so that now we're actually looking where if the market continues on its current path, they become winners. And it's that ability to control that risk that is, I find, so appealing. And, it just kills me that the irony of it is that people say, oh, the stock market, options, foreign currencies, you name it, is so risky. What's risky is not having a game plan. What's risky is not having education. I think the greatest risk in life is ignorance. And
I agree. No, what I see as risky for a consumer is 401k. It's better than nothing, but that's what I see as risk. What I see as risk is working for decades and decades and decades, exchanging your time for money and then putting that money into a savings account in a zero interest environment where we inflate in the dollar to values. That's what I see as risk. Going out there and doing a cover call on Apple, are you kidding me? That's not risky. Okay. I mean, put a stop loss, you're good to go. It's Apple, for crying out loud. Ignorance is absolutely the most grappling risk that you potentially do have. Absolutely no doubt about it.
Absolutely. So again, get out there. That's the point. Tackle trading.
Yeah, and then the third thing, Noah, I would say is what really kind of holds people back from their success is the excuse of time. Okay, Noah, why do you have so much time to go build businesses, place trades, travel, enjoy an amazing life with your $2? Why do you have more time than anybody else?
Because I don't have a day job, and it turns out, Matt, one of the scariest days of my life was the day I quit my corporate job in sales. I was selling software at the time, and I had gotten to the point where my trading was good enough to give me the confidence to tell my boss to stick it where the sun didn't shine. But I did it on impulse because I was tired of being micromanaged. And I knew that there was a better way, and I didn't know what the future held. I didn't know that I was going to be able to earn a living and to support myself through trading and through these avenues. But in fact, I was so amped up on the emotion and just the pure adrenaline of it. I got a speeding ticket on the way home that day, and it was perhaps the greatest decision I've ever made. And it turns out I'm completely unemployable, because I'm not going to do those demeaning little tasks that take my time up. And I've just learned the value of my time. I've learned the value of my own self-worth. And it is, it doesn't matter how good your job is. It was a great job. I had a great job, good income, good benefits, but what I didn't have was time. And, when I first made that leap, it was terrifying. But when I figured out that there is always a way, for you to support yourself, that money's not scarce. It's it's out there. It's all over the place. In fact, with the current interest rates and the environment with the monetary policy, it's everywhere. You can get your hands on money. And there's, that's one of the big secrets out there is just to change your mindset and you can't be afraid to fail, because your failures are going to be your best teachers in life. And the key to success, in my opinion, is to make as many mistakes as you can, as fast as you can, and to learn through other people's mistakes and experience. And the very best thing you can do is have a good mentor. Have good mentors. I mean, I've had multiple mentors throughout my life. Many, many, many mentors in trading, in communication and speaking. I mean, I've worked with lots of different people to help me become a better version of me. And, I'm not, particularly educated. I was a rock solid C student through school. I had school teachers ask me if I was, the black sheep of my family. And I was definitely not, going to graduate with honors by any stretch of the imagination. The only reason I got to go to any sort of college is because I had an athletic scholarship. And not knowing what I wanted to be when I grew up, I tried to postpone the inevitable by going to school forever. And, it turns out if they just had a major if you could have majored in money, if you could have majored in making money, if you could have majored in everything that had to do with money, I think more and more people would choose, what's your major? Oh, my major's money.
Money.
Yeah. Oh, they don't offer that major at school, but it's there. And if you look at it, there's really three core avenues for it. And it's, in my opinion, it's trading, business, and real estate. Those are the places where people create independence through their own trading and investment. They're investor class. They are entrepreneurial, in spirit, and they, understand the value of assets like real estate, cash flowing assets, the ability to write a credit spread, so on and so forth. So true, Noah. And you quit your job much more than I did. I quit in 2010. But I'll tell you this: once you've seen the other side of the equation, once you've seen the freedom that being an entrepreneur, has, you'll never go back. And that's why I love what you said in terms of, you're 100% unemployable, because you've seen what the other side of that equation represents. And it represents not only economic and financial freedom, but it represents freedom to spend with your kids. It represents freedom to spend with your family. It represents freedom to do whatever you want to do. And Noah, what is quite telling to me in terms of from a national economic perspective, for 240 years, Noah, small business creation in the United States had increased every single year. Not 1 year from the creation of this great country in the 18th century till 2009 had you not had more small businesses created in this year than you did in the preceding year. And yet over the last 6 years, Noah, every year you've seen a decrease in small business creation. And that is very telling to me. And we're from an entrepreneurial perspective, we're losing the battle. We're losing the battle in terms of, the battle between the American consumer, the American mindset giving up and getting more complacent and getting more lackadaisical and giving more authority, more freedoms away to government and Wall Street and corporate America. You know what? We have a responsibility, and Robert Kiyosaki taught us this, Noah, that we have a responsibility to get out there and fight that battle, to get out there and show people that they can take back their control, they can take back their freedoms. And like we said at Tackle Trading, we're just doing it through the investing perspective, but there's other ways to do it as well. Create a small business. Get out there and create a business mindset. Get out there, invest in real estate. Get cash flowing in the market. Invest in, currencies and commodities, and invest in, the marketplace, not just from a bullish perspective, but from a bearish perspective as well. And Noah, it's been an absolute honor to have you on the podcast here. You've been
been listening to the Trading Justice podcast presented by Tackle Trading. Our special guest, Noah Davidson, Coach Noah from Tackle Trading, one of the 4 original owners of Tackle Trading, along with Matt Justice, Tim Justice, Noah Davidson, Gino Poor. We're going to get out there. We're going to help you guys get in the market. We're going to help you take control of your financial future, one trade at a time. You can catch the podcast on Stitcher as well as iTunes and TuneIn and many other areas to really get this podcast. And if you like the podcast, ladies and gentlemen, go out there and leave us a nice little 5-star review, written review as well. Tell everybody how amazing that the Trading Justice podcast is, and tell a friend about it, ladies and gentlemen. If it's helping you, if it's entertaining you, tell somebody else. Help us build this podcast so that we can get out there and fulfill our responsibility of getting the information out there to the American consumer so that they can start controlling their future as well. And let's build this thing. Let's build this brick by brick, one trade, one person, one coach at a time. Noah, thank you so much for being our guest on the Trading Justice podcast. We are out.
You've been listening to the Trading Justice podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.